Hi, I'm Jimmy. In this video, we're looking for ETFs that could do well with a strong dollar. Now, many people may know that recently, as the economy struggled, as the Federal Reserve has increased interest rates, the dollar has gotten fairly strong relative to other currencies around the world. Well, some ETFs are better positioned to do well in that environment. So that's ultimately what we're looking for. Now, just so we're all on the same page, an ETF is short for exchange traded fund. And basically, it's a fund put together by a company that creates a set of rules. Their rules create which, decide which investments go into that fund. So it's ultimately becomes like an automated investment in many cases, in most cases, becomes an automated investment portfolio. So we can buy the ETF. It's just basically a publicly traded portfolio that we can jump in and buy. So that's what we're looking at here. We're looking at 4 different ETFs that could do well with a stronger dollar. That's ultimately what we're after. Okay, now these ETFs will include things like we got one that's good for dividends. We're trying to pay attention that some of these are global companies. So whether I live in America, if we want to invest in global stocks, or if we are living abroad and we want to find stocks or ETFs that could do well there. Plus, we found a couple that are pure play. These do well. These are built for a stronger dollar. We'll show you some of those in a second. But for now, I want to tell you real quick about a website that we're building where we are trying to make it quick and easy to research and value companies. So we've already built the discounted cash flow calculator portion of this that does very well for larger blue chip type companies, well-established companies. But the plan is to introduce all these different valuation methods so we could punch in any ticker, whether it be a bank or a fast growing company, and the website will return those valuation methods that are best for that particular company and tell you what the valuation method is. So, like I said, right now we got the beta version of the DCF calculator up, and we're gradually introducing more versions, more valuation methods. But the advantage of signing up now while we're in the beta version is that if you sign up now, let's say you were to come over to the website, you sign up on an annual basis, and well, the price you pay, you will get locked in. The price will never go up on you. So that's the advantage of signing up now versus waiting for it all to be done down the road. So if you'd like to sign up, I'll leave a link in the description below. But for now, let's jump over to the ETFs that could do well with a stronger dollar. Okay, our first ETF that's good for the strong dollar is the Invesco US Dollar ETF. Invesco DB. DB, if you're curious, is short for Deutsche Bank. But basically, what this ETF does is this ETF tracks the US dollar versus a basket of 6 different currencies. It looks at the euro, the yen, the pound, Canadian dollar, Swedish krona, and the Swiss franc. So it goes through those different ETFs. It compares the dollar to them. So as long as the dollar is strengthening compared to them, this ETF will move higher. Year to date, this ETF's up about 20%. So it's doing fairly well. The ticker symbol on this one is UUP, and they charge a fee of 79 basis points. 79 basis points is actually on the high end. I prefer not to pay fees up that high unless the ETF is a highly specialized ETF. You will see some very specialized ETFs that charge higher fees, and I get it. They're offering a more specialized product. So it's still less than 1%, which is good. By the way, that up 20% is after fees. Fees come out right out of the fund assets. So any returns you see is after fees. So overall, this looks like this could be one good ETF for a strong dollar. This one is traded in the US. Okay, another one, very similar to this one, is the Wisdom Tree US Dollar ETF. USDU is the ticker. They charge a fee of about 50 basis points. Year to date, this ETF's up 16%, which is good, but it's not quite as good as the Invesco ETF. Now, this ETF does pretty much the same thing, except that the basket of currencies they're against is a bit more. So it's the US dollar versus all the other 6 that I just mentioned, but also the Mexican peso, the Chinese yuan, I believe, the Australian dollar, South Korean won, and the Indian rupee. So this is a more all-encompassing ETF, and depending on where we live in the world, a lot of it could make sense. So if we lived in India and we were looking at these 2 ETFs, I would probably choose the one that includes the Indian currency in there. So if the dollar strengthens versus the Indian currency, well, should do fair. That ETF is likely to do better. Okay, now moving over to another ETF that's more focused on individual stocks, and that is the Vanguard S&P 500 ETF. Now, what's interesting about this one is traded in London. ticker symbol VUSA. Now that's important because the S&P 500 is down about 25%. But because this one is traded in London, especially if you live over there, if you live in London, you live in Europe, where the dollar is strengthening versus those currencies, well, the dollar is rising. And you can see that this ETF's up 1.5% over the past year compared to the S&P 500. The actual S&P 500 in US dollars is down like 20%. So this could be a good way to get involved in very large companies, but do it in the British pound, which could do a good job of hedging against the rise of the US dollar. Okay, now the next ETF we have is a dividend ETF. This is the Vanguard High Dividend ETF, ticker symbol VYM. They charge a fee of about 6 basis points. Now, I hesitated on this one a little bit because it's not as much of a pure dollar play as the other ones. But historically, when the dollar has risen, strengthened against some of the other global currencies, this ETF tends to outperform the market, which is a good thing. Plus, dividend stocks, even ignoring the dollar for a moment in a weak economic environment, dividend stocks tend to do fairly well. Perfect example of that is over the past year, this ETF is down less than 5%, 3.8%, while the S&P 500 is down like 20%. So this is a good way to own. This ETF has hundreds of different companies in it, dividend-paying companies. So this ETF is a good way to own a bunch of dividend-paying stocks that if things pull back, well, it should do fairly well. So if the market continues to fall, I would expect an ETF like this to continue to outperform. So it could be a defensive hedge, albeit not the purest strong dollar hedge. Now, if you'd like to sign up to get access to the website, I will leave a link in the description below. Or if you want to watch the video that we did the other day on good ETFs in a high inflationary environment, again, leave that link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.